Welcome to Money Secrets with Bill and Mike.
I'm Bill Alexander.
And I'm Mike Tove. Last week we were talking about the stock markets.
We were.
And
investing.
And I want to raise the other question, the ugly, the elephant in the room is, are we going to have a crash? And you certainly see there's tons of articles out there about doom and gloom is around the corner.
Well, the stock markets are complicated. It's very difficult, even for experts. You know, the expert,
Right.
You know what a definition of an expert is.
Someone
Someone who can explain today why they were wrong yesterday.
Okay, well, I always heard it was somebody who was 25 miles from home with a slideshow.
There you go.
But anyway, so we will be back in a minute, and we're going to talk about this. Please stay tuned. Welcome back.
Well, first, Mike, I think we should at least tell folks the fact that it's very difficult even for experts to understand the markets and the movements in the markets. And part of that is because so much of the market is not based upon what's actually occurring. It's based upon what people anticipate or expect.
Right. Well, last week's episode was about markets are complex, and this is a big piece of where it is. Because when you go buy an individual stock, at the very first time, it's called an initial public offering. Mm-hmm. That's when you're actually buying a share of a company. Anything else, you're buying it from somebody else who thinks that it's time for them to get rid of it.
Well, one of the things just for me is not understanding exactly the movements. You might be following a company and the company reports a fabulous return.
Right.
And then their market, then the stock actually drops because the analysts out there were thinking that it would actually do even better than it did.
A few years ago, there was an example, and I don't mention names, but in this case, I actually don't remember which company it was, so it doesn't matter.
That helps.
But there was a case of a company where the third quarter report came out, and as soon as the markets opened, the value of the company started to plunge, and it was just in free fall going down, 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 down. And the CFO came out and said, fellas, you don't get it. Yes, we had more expenditures than what was originally projected. It's because we're growing, we're expanding, we're doing all these wonderful things. And as soon as he said that, the stock turned around and it shot back up and it ended up in positive territory. It was one of the biggest bounces ever. And it had nothing to do with reality.
Exactly.
It was 100% perception. Many years ago, in fact, it was in the mid-90s, economics professor at Yale University, Robert Shiller, was doing a briefing to the Fed. And at the time, it was Alan Greenspan was the Fed chair, and he told the Fed that markets were not rational. And in fact, he used the term irrational exuberance. Greenspan, a few days later, quoted Shiller in a Fed policy speech, and Greenspan basically said, so how do we know if markets have irrational exuberance? Well, don't worry about it. That's what he said, and the very next day the markets plunged around the world anywhere from 2 to 4% because of two words, and don't worry about it. So there's nothing...
And of course, Shiller is the Nobel Prize-winning economist, a brilliant economist for sure.
And has been advising the Fed for the last at least 3 Fed chairs and many of the countries of the G8.
I think what worries most folks is the potential, or that the market as a whole, that we'll see it crash.
Right.
So I think we need to talk
And there's so many,
that.
because there are a lot of articles and there's a lot of people out there that are predicting this, including Shiller, although you have to be careful because that's not really what he says. If you look carefully, what he says is he says that markets are overvalued, and they are.
Well, Mike, I just read an article in the newspaper yesterday that said everyone thinks the markets are fine and continue to go up, and they're given all this justification. Is that the exuberance that we've been talking about?
Yes, that is exactly what was but that's exactly what they were saying back in 98, 99. Right when Shiller's irrational exuberance was, I believe it was 96, and that's exactly what they were saying. because everything was going up and up and up.
Well, it's also what most experts were saying in 2008, right before the market crashed, too.
Right. But what's interesting is that I will come into work and I will listen to the futures, the projections of what markets are supposed to be for the next day, and amazingly, half the time they're right.
Half the time. Exactly. That's the problem.
But that's the problem. But here is the thing. I mean, every school kid out there knows that how you invest is you buy low and you sell high, right? Now, we have a little graphic for that. But what does the research say? Well, Shiller's CAPE index, and CAPE is just a way of measuring the value of the markets, okay? There is a dark line in the graph, if you can see the graph on the screen. That is where it's supposed to be. That's the average. We are actually more overpriced. The valuation of the markets are higher than they have ever been in U.S. history, except for Y2K, including Black Tuesday 1929. And so just by buy low and sell high, that predicts that people should be selling. But when they do, what's going to happen is markets are going to come crashing down.
Well, at least from everything I have read and researched, the market generally corrects at least twice every 15 years, does it not?
Yes.
Well, when was the last time we had a market correction?
We are now, right, we are now approaching the start of our 9th year. This is the longest bull market run in U.S. history. And so it's not that markets are bad. It's not that the economy is doomed for whatever reasons. It's because it's time. Markets are cyclic. They always have been, they always will be.
That's not going to change, right?
That's not going to change. They go up and they go down, and they go up and they go down. And so the key isn't fearing what is, it's understanding. And it's developing strategies that are smart based on where you are in life and what there's likely to do.
Well, I think that's the key, Mike. I really do. It really comes down to what's likely to happen sooner than later. Of course, nobody can predict how much, but
oh God, I wish I could.
I know, we'd be rich, wouldn't we?
We'd be millionaires.
But the thing about it is that I think different investors, based on age, time of life, those kinds of things, may want to treat what we expect to happen differently. And I think when we come back, that's really what
that's what I want to come. So stay tuned. We'll be right back, and we're going to help you understand how to navigate this in a good way. See you soon. Welcome back. Okay, Bill, so how do we help people?
Are we going to have a correction?
Yeah, of course we're going to have a correction. The question is look, just using the math, all right? We are approaching being overvalued in the markets by 2 to 1.
That's a lot.
Now, that's a lot. Now, there are those that would justify that it's not really that big because of a whole bunch of technical reasons. It doesn't matter. If you just take that at face value and the markets just correct to get back to where they are supposed to be, their 137-year average, which is half of where we are now, that predicts that the markets will correct by 50%.
Do you think it'll happen in the next 3 to 6 months?
You know what? If I had that answer, I would be out shorting the heck out of it.
Well, of course, the thing about it is that
know.
many of the smartest economists around are saying in the next 3 to 6 months we'll have a correction. Of course,
they've been saying that for a year and a half.
The problem is that the timing of it is never known.
No.
And so
the timing is never known, and the cause is never known.
Well, let me ask it a different way then. Is this the time for people to be buying equities right now?
The answer is it depends. And this, of course, is why this is all complex. So let's kind of explore something here. One of the things that I tell clients a lot is that there's really three phases of investing. The first is the accumulation phase. So this is where you are introducing new dollars into your investment accounts. Now, last week we mentioned that the biggest one is a 401k, and this is where it is. You're contributing a portion of your salary. Hopefully your employer is matching you. And we have said in the past that if your employer isn't matching, don't use a 401k. But this is called an accumulation stage. And here is the reason why it doesn't matter. When markets are going up, your account's going up and you're happy, everything is great. But when markets are going down, you're still contributing. And a fixed dollar is now buying more and more and more. In other words, you're buying at a deeper and deeper discount. And who doesn't like to buy stuff on sale?
True.
So basically, when you are in an accumulation phase and markets are going down, your dollar is buying more and more shares. And so when the markets eventually recover, and that's the one thing that is pretty universal in this country so far, is that when we have a correction, we do recover.
Right. Now, when you're talking that, you're really talking equities for the most part.
Yes, I'm talking equities.
Because if you're in bonds,
no, that's no
not
good.
going to happen.
It's not going to happen, and in fact, it gets worse because of the bond risk is in a different direction.
Right.
So equities, yes. But when the recovery occurs, you have so much more of it, you have gone up. So in the accumulation phase, this oscillation, this highs and lows, ups and downs.
All right, but what about me? I'm
good.
66
Yeah,
years old.
well,
Where
the
am
math,
I?
yeah, see now, the math is different. It's the same math, but it's in reverse. And so the thing that was so beneficial to you in the accumulation phase is now devastating to you when you are at a place where you're taking the money out.
In other words, I need to be risk averse.
Correct.
Well, what I want to tell folks is that particularly when you get into your retirement years, you really have to be cautious of losses, because let's say we have a correction that's not so bad. Let's say it's a 10% correction. If my stock market portfolio dips by 10% this year as a loss, I have to earn 20% to get back to zero.
Right.
And that's hard to do.
That's
right. It
right.
takes a long time.
Yeah, and yes, and that's the problem. And then of course, there's three phases. One is the accumulation phase. Two is what I call passive, which is, okay, you're not putting any new money in, but you're not taking any money out.
Don't need it yet.
But then the third phase is the decumulation phase, which most of the time is mandatory because what happens?
You have required minimum distributions.
Required minimum distributions.
But more important than that, so sometimes I need the money to live on.
Right. But the point is that as soon as you start taking the money out, the thing that benefited you so much on the accumulation phase, which technically is known as dollar cost averaging, when the money comes out, it goes in reverse, and it is devastating, and it's the reason why financial experts constantly say that at the point of retirement, one bad year can ruin the rest of your life.
Correct.
And so it's not that the markets are good or bad, they're neither. They are what they are.
Even with dollar cost averaging, if you're just getting into the market,
oh, it's much
then
more.
Now, well, it's sort of like this. You don't want, let's say you have $100,000, this is your first investment, and you put it into the markets, and then it drops to $50,000. That's the very worst time to do that. That's not dollar cost averaging. And I just say that this is a time where people have to be more skeptical about that kind of investment.
Well, the truth is that the value of dollar cost averaging is the greatest when the dollars going in are a larger proportion of the total value. So if you are investing $10,000 and you have $10,000 in there already, the dollar cost averaging factor is tremendous. When you get to the end, the extra 10,000 against 100 or 150 or 200 or 300,000, the proportionality is not as great. So what happens is that through the years, the impact of the volatility shifts from being positive to a negative.
Well, that's true, but that's assuming that you're basically investing about the same amount each week or each
Well, that's
month.
what dollar cost averaging is.
Exactly. But I mean, for instance, for those folks who may have sold their home and they maybe have $200,000 or $300,000 that they would like to invest, this is the time to be very cautious.
Okay, well, that's
with
not
that.
dollar cost averaging.
I
Dollar
know
cost
that. That's
averaging
what
is
I'm
when
saying.
you're putting in on a
Yeah.
regular basis every
Right.
single month,
That's
month in,
the
month
point
out.
I was trying to make.
Right.
But there's a
Okay.
difference in terms
Yeah, well, that's
of,
just investing.
of
So,
the like.
yeah, so there are a number of things. In any event, we're going to take a short break, and we're going to come right back and start to wrap some of this up. Welcome back. So, Bill, I think one of the things is that people, we said in the last week that markets are a lot more complicated than people think, and I think this is one of the areas where they are. First off, a lot of people try to be self-investors.
Mm-hmm.
And the problem with that is they do not have access to everything that's out there.
No question about it, and clearly the markets go up or down, quite frankly, based on folks that we don't have any idea where they're going with it.
Right. The other thing is, and I've actually done a study on it. In fact, on my website, there is an article in there. I have in my website, if you go to the website, www.ain-services.com, there is a resource library, and within there's an article where I actually took and I looked at the 6 major market indexes and I superimposed them on each other. And they are moving in lockstep with each other. What used to be diversification because of different objectives is much less so today than it was a generation or two ago.
And people need to know that because they don't really know how to diversify.
It's because we are in a global economy, because we have instantaneous information. What happens in China happens over here a nanosecond later. And so what the patterns that worked 20, 30, 40 years ago, they're not working the way they used to anymore because times have changed.
Well, you know, I represent a lot of older clients. And,
So do I.
And I know you do. And I think what I'm really trying to say to those folks is this is a time to be cautious. It is likely that we will see a correction sooner than later. Well, I mean, none of us can tell us exactly, but I think it will occur sooner. Folks cannot afford to lose money when you're my age or older because we need it for our retirement.
Right.
And
plus, we don't have the time to, even if we don't need it for retirement, we don't have the time horizons to grow it back. We're not working anymore in retirement,
but
so you don't have earned income.
The other things that I'm looking at are the fact that we know that the Fed is pulling money out of the economy. They're raising interest rates, slowly, but they're clearly raising interest rates. We also know that this new tax law is going to require the government to borrow more money. These tax cuts are really coming on borrowed money.
Well, I want to do a show on that, maybe 2 of them actually.
Well, absolutely, and I think that's where we're going.
Next week.
And I think that's going to be important for folks. But the bottom line is that there's a lot that will take place based on policy that will also potentially push the markets into a correction.
Oh, I agree 100%. And the key is
well,
that...
what's the money secret,
Well, the
Mike?
money secret, okay. So basically the money secret is that markets are neither bad nor good. But what they are is they are bad or good for different people depending on circumstances. There we go with that obvious thing again. Well, and so, people go, well, I don't want to go to a professional fund manager or money manager or a financial advisor because they charge money. But the truth is that if you get advice that is worth what you're paying, then it's good. The problem is when people pay for advice that's not worth what they're paying.
No question about it. Well, finding a trusted advisor that you can stick with and one who really knows your objectives and can give you the right kind of advice for your objectives That's what's so meaningful.
That's the secret. Stay tuned. We're going to be right back, and we'll see you in a minute. Welcome back. So, Bill, we're going to wrap this up for today. We do have a book coming out, and anybody that wants it should get a hold of us to
Absolutely.
to
Well,
get our
we hope
book.
this show is meaningful, helps folks understand how these things work. But actually, our book is even more helpful
Yes.
because it's much more thorough than what we can do. And
Absolutely.
tell folks about our
Okay.
book.
Well, it's called Money Secrets with Bill and Mike.
What a
And it
great name.
What a great name. But anyway, so look, I'm Mike Tove with AIN Services. I do financial planning, and we can be reached at 800-363-2296.
And I'm Bill Alexander. I'm an attorney with W.G. Alexander and Associates in Raleigh. We focus on estate planning, asset protection, and elder law. Tune in to my radio show on Saturday mornings at 11 o'clock for Asset Protection Today on WPTF 680 AM.
And next week, join us. We're going to start talking about the new tax laws and how they are going to impact you. And you don't want to miss that one because there are going to be some surprises,
There's
I
some
think.
positive things about it, and there's some
then
negative
there's some
things
other
about
things,
it. You just need to know the good and the bad.
So join us next week, and thanks for watching today. See you.